Financial planning and investment management services provided through Certified Advisory Corp. CAC, a federally registered investment advisor. CAC is a federally registered investment advisor and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized legal, tax, or investment advice, but are limited to the dissemination of general information. Listeners should consult with a legal, tax, and/or investment professional for advice specific to their needs.
Stay tuned for On the Money, Central Florida's most listened to financial call-in show, brought to you by Certified Financial Group in Altamont Springs. It's the only show hosted exclusively by certified financial planner professionals. Monday through Friday, their CFPs provide financial planning and investment advice for a fee. But on Saturdays, the advice is absolutely free and has been for more than 30 years for their WDBO listeners. If you have a financial question you want answered by real fiduciaries, the lines are wide open. Call 844-580-WDBO. That's 844-580-WDBO. And enjoy the show.
Good morning and welcome to On the Money right here on WDBO 107.3 FM, AM 580. Always streaming live inside your WDBO app. Josh McCarthy today, joined in studio today as I am every Saturday morning with a couple of experts live from the Certified Financial Group answering your questions. You heard something in the news and it kind of left a little imprint on your brain. You're like, I want to ask the experts if what I heard is true. It's been a very interesting week in the market, so it's a good time to ask those questions. We want to make sure that you are safe to get to and through retirement in the best situation as possible. That's what we do here at the Certified Financial Group. By we, I mean the experts. I'm just the radio guy who pushes buttons and says words. But I know some people, and those people are the Certified Financial Planners with the Certified Financial Group, answering your questions live on the air for over 30 years on WDBO. We got Joe Bert and Aaron Bert. How are we doing this morning?
We're doing great, Josh. Good to be with you again. As you said in the intro, we are here to take your calls as we have now for more than 30 years. And I was reflecting about how long we've been doing this and how we do it. And I tend to turn the dial during the weekend and listen who's on and what other folks are saying. And, you know, everybody else has a canned, except, well, I should say we do a live show on Saturday. But if you're listening on Sunday morning or Saturday morning at 7, this is the recorded show. But nevertheless, the show that's been recorded has been produced live. And I think we're the only live show in Central Florida. Everybody else does a 1-hour infomercial, but we are here for you to answer your questions, things that might be on your mind regarding your personal finances, decisions that you're trying to make regarding your IRA or 401k, long-term health care, life insurance, your mortgage, taxes, inflation, all that stuff that Aaron and I and the 15 other certified financial planners work with our clients, working with them as fiduciaries, and I'm going to talk about that in just a minute. As fiduciaries, providing retirement planning and investment planning for a fee on Monday through Friday. On Saturday morning, we are here for you absolutely free. So if you have any questions regarding your personal finances, we are here for you. And the good news is the lines are absolutely wide open. So all you have to do is pick up the phone and dial these magic numbers.
The magic numbers are 844-580-9326. That's 844-580-9326. WDBO, or send in your open mic using that free WDBO app. The topic of today's show, I want to give you some perspective on the recent market volatility. Should we be concerned?
Yeah, so it started the week before and kind of leading up to Monday, the markets kind of did what markets do, and it made people really, really, really nervous. And so we wanted to provide some perspective on, what that was all about and why that may have occurred. And it really kicked off after the Federal Reserve meeting that occurred, where there was some expectation about, talking about rate cuts, because right now there's a lot of talk about what high interest rates are doing to the economy and what high interest rates are doing to the jobs market and to growth and a bunch of other things. And so there's been the expectation now that rate cuts were going to happen. And really what was happening is the job market was so strong and inflation's been coming down. The Federal Reserve has kind of taken their eye off of doing rate cuts leading up to this last meeting. And really in this last meeting, they discussed that no rate cuts were going to occur at that meeting. But going forward in September, there's the expectation that there's going to be some sort of rate cut. So that was kind of the backdrop for how the volatility kind of kicked off. And then there was a jobs number that came out. And the jobs number was not very good, didn't meet expectations. And so then the panic hit of people considering or thinking that maybe the Fed should have cut rates and second guessing what happened. Anyway, long story short, it's a lot of words to say that there was volatility in the markets in the last couple of weeks, and we saw, and you see these numbers nowadays. What was it, 1,000 points on the Dow and a couple hundred points on the Nasdaq, and people see these big numbers, but when you're looking at those like 1,000-point drop coming off of a what's the Dow at now?
39,000 plus, but that's the important thing. You've got to look at it in percentages now, not points.
Not points, because points.
Right.
I mean, when the Dow was at 5,000 and
right.
you lose 1,000 points, that's massive. It's
right,
it's at
right.
40,000,
right.
you lose 1,000 points, not so much.
The 87 drop was 23%. So if you'd have taken 23% on 40,000, you'd be almost 10,000 points.
Yeah,
that'll get your attention.
Yeah,
that would get your attention.
Yeah.
So, but when you say 1,000 points, oh my gosh, the world is coming to an end. It's really less than 2.5%.
Right, and then you have the flashing lights on the TV and then the media and then social media and just kind of spun a lot of people up, and then that kind of cascaded actually for about a week, and so there was a period of time, really from the high, which was mid-July. There was fluctuations going back and forth all the way until about August 2nd, August 3rd. We actually hit correction territory in some of the major indices, including the Nasdaq was down over 10% over that period. The S&P was down, I believe, 7%. Is the rough number. And that got some people's attention because, a 7% drop over a couple weeks is pretty significant. However, there was a couple things that also happened at the exact same time, which many people didn't realize. Now, if you're just looking at the S&P, the Dow, or the Nasdaq, that's what people look at because that's what's regularly reported. But
right.
what are the other things that are out there that people should be looking at?
Well, they should be looking at the rest of their portfolio. You've got small cap, you've got international, you've got real estate and bonds, my friend, bonds.
It's exactly right.
That's right.
So the 60-40.
And you didn't coach me.
I
like that. All
yeah,
right.
so we have a little back and forth there. So the 60-40 portfolio, 60% being stocks, 40% being bonds. The bonds finally did what they were supposed to be doing because there was the anticipation of interest rate cuts coming forward. Bond yields started to drop. And what happens when bond yields drop?
Prices go up.
Prices go up. So what was happening is simultaneously while stock prices were going down, the bond prices were going up. And people that were in a well-diversified, not 100% aggressive portfolio, really nothing really happened to them. It was
right.
kind of just some noise in the background.
Right, and we let all of our clients know. We sent them a blast email and let them know that despite the fact that the market had dropped, if you measure it by the S&P 500, 4, 5, 6%, their portfolios are almost untouched simply because of what you said, and that's why you want to have diversification. Unless you're an aggressive investor, which most people, unless you're really young, should not be 100% aggressive, or unless you have just money that you're really investing for the real long term, maybe not for yourself, but maybe for future generations. You want what we call a moderate portfolio, which is where about 80% of our clients are, and they felt almost nothing in terms of what was going on last week. And I had dinner with some very good friends on Wednesday night, and they said, "Boy, I bet your phone is ringing off the wall with what's going on." I said, "Bill, we didn't get one call. We did not get one call from our clients simply because perhaps they looked at their portfolio, or simply because they also know too that they're well diversified with quality and won't get hammered in these kinds of portfolios. And that doesn't mean that when the markets go down, something won't happen. Now, if you're in the rainstorm, you're not going to drown, but you're going to get a little wet. And that's what investing is all about. And that's what you have to do to get better than average long-term returns. And that's what investing is all about. And we were talking about the indices. People focus on the Dow. That's only 30 stocks.
Right.
And unless you really owned those 30 stocks and you're entirely in your portfolio, that 1,000-point drop didn't mean anything to you. And the S&P 500 is 500 of the largest U.S. company stocks, which is now dominated by just a handful of companies like NVIDIA and so forth. And our clients have not only that, they've got that exposure to that, but they also have mid-cap, and they have small cap, and they have real estate.
The real estate was one that really helped out as well over that same period.
Yes.
The interest rate sensitivity. So the point of the whole
Tell me the point there.
The point of the whole conversation is that you need, if during that time period you experienced a significant drop in your portfolio, you may want to be looking at yourself or your advisor and say, why am I not more diversified than what I'm in? You may just be in the S&P 500. If you want to be really aggressive, it's going to be an exciting ride, but you'll probably you're going to see big drops and fluctuations like that. And part of the reason why I bring this up, because it's normal for the S&P 500 to have big drops. And I had a little cheat sheet here. The frequency of 5% or more decline in the S&P 500. How often do you think that happens?
How often?
Yeah, in a year. How often do you think that happens?
A couple times.
3 times a year. That's the average drop. The S&P 500 drops 5% or more on average 3 times a year. Last time it happened, just happened, right? Before that, it was April of this year. A 10% or more drop. Any idea?
Are you going to have that once every year?
Every year and a half.
Year and a half.
And it
What is it, stump the host or what we got going on?
And it lasts about 126 days, so about 4 months.
Yep.
Is how long you're going to experience that correction, if you will, in the S&P 500. 15% more drop happens every 3 years. Every 3 years, you're going to see a 15% or more drop, and in 20% happens at about every 5.5 years.
And that's what we call a bear market.
And that's on the S&P 500. And those last about a year.
Yep.
So if you get a 20% drop, that's going to be about over a year period that's going to occur to you. Now, that would be pretty painful if you have a 20% drop that lasts more than a year, which is why you have to do planning and figure out how you should be positioned appropriately so that if that kind of drop happens, especially as you near retirement or enter retirement, that you don't need to be selling investments when they're 20% down in order to eat and pay your bills and do all those things.
That is the key. You don't lose until you sell. And if you're well diversified with quality and you've done some planning and you know that when that happens, it's going to happen. Like you said, it happens every 5 years plus. It's going to happen. There's no way to avoid it. That you're positioned, that you're not going to be forced to sell when things are down. And when you need that cash, you've got that reserve built in your portfolio to draw from. And that's what planning is all about. Unfortunately, what we see when people walk into our office and when those kinds of things happen and they're bleeding simply because they're really aggressive, they lost all that money, and they were forced to sell on their assets because they needed the cash. And that's why I think planning is so important. Good investing, number one, requires good planning up front. Unfortunately, most people don't do the planning. They go online, they go to Morningstar, they listen to guys on the radio. This is what you're going to do. Put all your money here. They go to some seminar, put all your money there. And they have done no planning. And when that rainy day comes, they find out that they didn't have the umbrella.
Now, I will say the challenge with good planning, good investing requires good planning. Good in planning, and we see this day in and day out, requires good data. So it's important that if you're going to come see a planner, whether it's us or anybody else, that you have kind of your arms around, what your accounts are, and so what your income's going to be. So Social Security projections, pension projections, if you have one, how long you plan to work for. And then the one thing that clients get wrapped around the axle about is what they spend, because a lot of people don't have a good idea of what they spend day in and day out. And so that's why we have what we call, it used to be called our blue form. Now it's actually a yellow form. We kind of switched the color up. So now we have our yellow form, which outlines all these expenses. And we give those out for free. So if anyone's interested in getting our yellow form, I'll tell you how to do that after the break. And I hear bumper music in the background. So we're going to go to a break, and we'll have more information on that on the other side.
Thank you so much, Joe and Aaron. If you want to join the conversation now, the number to call is 844-580-9326. That's 844-580-WDBO. Send in your open mic using that free WDBO app. You got a question that popped up in the news, you've been listening, and Joe and Aaron may have spawned a question inside your very head now. The number to call, 844-580-9326. You're listening to On the Money, where we're helping you plan tomorrow
Today
with the Certified Financial Group. Welcome back to On the Money here on WDBO 107.3 FM, AM 580, always streaming inside your WDBO app. A couple of certified financial planners with the Certified Financial Group answering your questions live on a Saturday morning. If you're listening around 9 o'clock, that's the live one. If you're listening Saturday at 7 or Sunday morning, then it's the version of this show that we put on the air so we can just get more information out there throughout the weekend. So you can see what Certified Financial Group does. They answer your questions that pop up. And if they do pop up, I invite you to call in, join the conversation. 844-580-9326, 844-580-WDBO. Send in your open mic using that free WDBO app. And we got an interesting topic here coming up. Look at a yellow form I see is what we're going to be talking about here.
Yeah, so just brought that up in the last segment when we were talking about how good investing requires good planning and good planning requires good data. And part of the data gathering process that we do is to actually ask people what their expenses are, because your expenses really are your lifestyle. That's what spend on your cell phone and your gym membership and your groceries and dining out and electricity and pet care and all that stuff and more. And so we want to know what your lifestyle is, because usually when people stop working, they want to continue their lifestyle, which is why they're accumulating money now so they can continue their lifestyle when the paychecks stop. And one of the best ways to be able to figure out what your lifestyle is to complete this yellow form, because it lists all these expenses that you may or may not have thought of. Everything down to your termite bond is on there. And so we're offering that yellow form out to anybody who wants to put some eyes on it and start, tracking their expenses. Because at the end of the day, there's two parts to the equation. It's what's coming in and what's going out. And what's going out is just as important as what's coming in. And if you don't have your handle on the what's going out part, then you're just kind of out there guessing, floating around, aimlessly. And so we're offering that yellow form. Anybody that wants it, you can go to our website. You can go through the contact us on the website. Just put in the comments of why you're contacting us. Just say yellow form, and we'll email a copy of that to you. We actually have it in Excel, too. We can email it to you in Excel as well. And really a great way to get your arms around what your living expenses are and start tracking that stuff. Because those people that are accumulating, we look at what's coming in and what's going out, and hopefully there's something left so that could be saved for the future. Conversely, those people that are in retirement, we have to try to plan around, what's going out and figure out how aggressively or conservatively those dollars or funds can be invested so that we can cover those expenses during the decumulation phase. So that's what we do with our clients.
If the outflow exceeds the inflow, the outcome could be your downfall. Got it? If the outflow exceeds the inflow. Yeah, that's pretty good on a Saturday morning.
All right.
If the outflow exceeds the inflow, the outcome could be your downfall. Don't let this data gathering turn you off about doing planning either with us or any of the great firms in town. Be sure they're certified financial planners. Remember, anybody can call themselves a fiduciary, and I hear it on the radio all weekend long. Everybody's a fiduciary. We put it in writing. So if they're going to do business with you, ask to look at their investment management agreement. They need to give you that. Ask their investment management agreement. And in there, see if they put it in writing that they will act on your behalf as a fiduciary. We put it in writing because we're certified financial planners, and we are required to do so. The point that Aaron made about good data is required to do good planning. Don't let that scare you, because we help you pull all that stuff together. Yeah. People come in sometimes with a shopping bag full of stuff, and we will help you sort it out. Yep. If you can't get your projections, we can get that for you. We've done it years and years and years and years and know how to do it. The point is, come seek help, and we can help you do that. That's what we do for our clients, and we're glad to work with you. And by the way, we don't work for free. So we know there's some firms out there that are using that as a gimmick. We don't do that. We are a firm that's been around for almost 50 years now. And we're glad to work with you, but we do offer a no-obligation visit. So check our website at financialgroup.com. That's financialgroup.com.
And the service at Certified Financial Group is well worth the investment. But you lied, Joe. You do work for free right now.
That's it.
The offers and observations and advice you give on the air right now. It's the 1 hour a week where, he's giving his time away for the community. If you want to call in, 844-580-9326, 844-580-WDBO. More On the Money coming right up, because this is where we help you plan tomorrow.
Today.
With the Certified Financial Group. Welcome back to On the Money here on WDBO 107.3 FM AM 580, always streaming live inside your WDBO app. The number to call if you want to pick the brains of Joe Bert and Aaron Bert with the Certified Financial Group. That's what they're doing right now. They're here to answer your questions. The number to call is 844-580-9326, 844-580-WDBO, or send in your open mic using that free WDBO app. If your question is of a more private nature, you want to get down right to the nitty-gritty of your personal finances or your personal family members, then Charles Curry is standing by to take any calls off the air, and that number is 407-869-9800. Charles Curry, Certified Financial Planner with the Certified Financial Group. He's doing his own private radio show just for you off the air. 407-869-9800. And Joe, Aaron, if there's somebody who wants to kind of meet Charles or meet Matt Murphy or meet one of the great planners you have in the office, there's a way to do that as well.
Yeah, regular workshops that we hold. Dave Bellachristian is having one today, and next Saturday morning, Matt Murphy is going to talk about IRA withdrawals through the 4 stages of retirement. This is one that's going to show you what you need to do and how to avoid the pitfalls that we see many people making, unfortunately. It's absolutely free. Go to our website. That's financialgroup.com. It'll be 10 o'clock this next Saturday at our office here in Altamont Springs. in our state-of-the-art learning center. It can easily accommodate about 35 people. Matt will provide some refreshments, and I guarantee you will walk away with information that could save you potentially thousands of dollars. So circle that on your calendar. That's next Saturday morning, 10 a.m. Go to financialgroup.com. You can make your reservations right online, and we hope to see you there. And if you get here a little early, you can come by and see the monkeys here in the studio doing the radio show as we are
behind the glass.
As we are behind the glass. That's right. Here we are. So I see we have a text question float in there, Josh.
You got it. If you want to send in your question using the open mic feature, you can do so inside the open mic or call or inside the WDBO app. That's where you'll find the open mic. Or you can call in live 844-580-9326. We had a text question from John. John wants to know, well, John just retired at 62, and he's concerned about taxes going up in the future and managing his RMDs. What strategies should John consider for reducing those taxes?
Well, let's first of all define what an RMD is. It stands for Required Minimum Distribution. It's what the government says you're required to take out of your retirement accounts when you reach that magic age now of 73.
If he's 62, is it 73 or is it 75? So with Secure Act that just came out, there's a couple. Anyone born was in the 60s. Anyone born in the 60s and on is now 75 years old for your required minimum distribution age. Anyone born prior to that is now 73 years old. So those people that are a little bit younger have a little bit longer to wait, and at that point, then you have to start taking distributions from your account. But at 62 years old, that's not something that you necessarily have to worry about quite yet. But the things that you do have to be concerned about are whether you're starting Social Security. So are you starting Social Security at 62? If you are, what other sorts of income do you have? If you're making part-time income, you are still subject to the earnings limitation for Social Security. A lot of people don't realize that you can start Social Security as early as 62 years old. But if you do so, then you can't really be working and making a lot of money or earning income, because the government takes away or basically reduces your Social Security benefit if you're before full retirement age. So that's one thing to consider. What your Social Security won't be taxable to you unless you are earning more money. So that's also something. Your Social Security becomes taxable to you at certain rates. And then you also have to plan around, what your distributions are going to be from your retirement plans, because some of that's going to be taxable to you if you have traditional IRAs. Roth won't be taxable to you if you make those kind of distributions. And if you have any outside brokerage accounts, obviously all that has to come into play. And then healthcare. So how are you bridging that gap from 62 to 65? Are you going on the marketplace? If so, then you have to manage your income to stay underneath if you're looking to get any subsidies from the marketplace plans that are out there. So lots of things to consider and kind of wrap your head around as you head into that. And we deal with that day in and day out with our clients that retire. How are we structuring your income to keep your income low so that those things aren't triggering, whether it's Social Security taxation or marketplace loss of subsidies, or making sure that you're not hitting those earnings limitations, or being subject to IRMA, by the way. So once you turn 65, IRMA kicks in for you as well, which is the increased premiums on your Medicare. So lots of things that we plan and do. So if you're worried about your required minimum distributions at 62, not something you necessarily have to worry about quite yet, but managing taxes and penalties and all of that kind of stuff is things that we deal with clients all the time. So if you're interested in getting more information on how to manage that, that's something that you can go to our website, fill out a form, and one of our 17 certified financial planner professionals will be happy to meet with you and walk you through how to manage that, what's going on with your retirement.
One of the things that we want to look at when you're in those retirement years, you're about to start retirement, generally your income will drop because the paycheck is gone. And then where are you going to draw the money from? We alluded to Social Security, maybe taking money from your retirement accounts, maybe you have a pension, rental income, investment income, so forth. It's an opportunity perhaps to do some Roth conversions, and it's one of the things we do when we do planning is that window there to do those Roth conversions when you're still in the 12% tax bracket, as opposed to bumping up to the 22% tax bracket. You generally don't want to make a big Roth conversion in 1 year because, as Aaron said, it could impact the premium that you pay on your Medicare and could impact also the taxation of your Social Security, being taxed at a higher degree than what it normally would be. So those are the things that we do with planning, and that's why planning is so critical when you're about to launch on that long journey, hopefully long journey that we call retirement. You want to get started down the right path and not go down the wrong path and find out you made some mistakes. So these are some of the things, coincidentally, that Matt Murphy will be covering in detail next Saturday morning in his workshop, 10 o'clock right here in our office. So if you want information about that, go to our website, financialgroup.com. That's financialgroup.com. Click on events and you can make your reservation right there. And I see we have another text question floated in there, Josh.
Actually, let me jump back to Roth conversions real quick. One thing that a lot of people don't realize, because we get this question a lot, is concerning Roth conversions. Can I convert my account? People don't realize that you can actually do what's called a partial Roth conversion. So you don't have to convert the entire thing. So if you have, we'll just say $100,000 IRA, you can convert $5,000 to Roth, and that $5,000 would move into the Roth account, and you would only be taxed on the $5,000. A lot of people think you have to convert all or none, and that's not the case. There is the ability to do what's called partial Roth conversions, and that's kind of the process that we manage with clients. As we look at their taxes every year and we figure, hey, how much income do we have? How much can we convert? How much is that going to cost us? And it's basically managing those partial Roth conversions to transfer some money from traditional to Roth while you're in those lower tax brackets before required minimum distributions or Social Security start for you.
And once again, the benefit of the Roth is the money grows tax-free and it's withdrawn tax-free. That's the bad news. The good news, the bad news is, of course, when you do that conversion, you're subject to taxation. That's why we want to do those conversions when you're in the 12% tax bracket, not in the 22 or above tax bracket. So those are things we look at. And some people say, what's the difference between a 12% and 22? That's only 10%. Folks, it's almost a 100% difference in tax. If you take from 12 to 22, it's about 90% more in taxes that you will pay. So knowing what you're doing in that regard is an important consideration. I see we have another text question. Let's take it away, Josh.
You got it. You want to join the conversation? Call in 844-580-9326. Richard has a question for you. As you know, Certified Financial Group helps people get to and through retirement, and it's that time of the life, I guess, that time of career for Richard. Richard said, my company has offered me a lump sum pension instead of a monthly payment. What factors should I consider in making this choice?
Well, there are several. You have to look at what the benefit is versus what they're going to be, what can you get in a lump sum versus what the monthly payout is. Then you have to factor in, is it for your single life or is it for you and a survivor? You have to look at what your investment options are. If you take the money out, are you going to manage it yourself? You're going to have it professionally managed. And then maybe the stability of the pension. It's a known fact. In fact, it happened to my father-in-law many years ago. He worked for Public Steel. They retired, thought everything was great, and before too long, the pension fund evaporated. And you see that, unfortunately, with some not frequency, but it does happen. And you're counting on that pension for 25, 30 years into retirement. So, and when you take that, if you do take the pension, though, you can roll it over into an IRA, and then it's your money. You pass away the next day, your survivors get it. So, there's pros and cons to that. Some people like the guarantee of the pension, but you want to look at that. Now, a lot of firms today are transferring their pension liability to an insurance company, which means you've minimized that risk of loss in the future. Unless the insurance company goes bust, and the chances of that are very, very slim. So I wouldn't have a risk there. But there's a lot of variables that are involved there, and you have to look at what's best for you and your family, your own personal situation. Anything you want to add there?
Yeah, and so you got to look at your need for liquidity is one thing. That's kind of one major thing. And that's kind of why they started it for those people that work in Florida in the FRS system. That's why they invented the drop program, right? So that you could start your pension early, start putting money into an account and get some liquidity, because what was happening is a lot of people were retiring, having their pension, and they had no liquidity. So if you needed to buy a car or something, you didn't have a pile of or pot of money that you could dip into in order to make those big purchases. So need for liquidity is one thing that you need to consider. As Joe mentioned, whether you're married and have a spouse, what the age difference is, what the difference in benefits from single life to 100% survivor to 50% survivor. If you're insurable, maybe it makes sense to do a pension max strategy, which is where you take the single life amount, the highest amount that you can get, and then you buy life insurance so that if you were to pass away or predecease your spouse, that they get a lump sum benefit to replace that pension income that they were counting on.
Okay, wait, let's unpeel that.
Sure.
Because we have done that a fair amount for people that have that pension option.
Yep.
And I've seen it work really well for people. And what you look at is what the single life option is, and that's one that, as you said, gives you the most money. So let's take an example. Single life option, let's say you're going to pay you $2,000 a month for your lifetime.
Sure.
If you take your survivor option, because somebody other than you is covered, if you pass away, they're going to get a benefit, but it's a reduced benefit.
Right.
So let's say the difference between if you take the single life is $2,000 and the joint life is $1,500.
Yep, it's $500 a month.
$500 a month. So what you've done, if you take the survivor option, you've just locked in that lower amount, that $1,500 a month for your lifetime, and you've given up $500 a month or $6,000 a year of difference.
Right.
So what Pension Max says, and it doesn't work in all cases, but when it works, it really works well. You take that a portion, maybe all or some of that $6,000 a year, which you've given up if you take the $1,500, and you buy a life insurance policy
Right.
to cover more than what that differential would make up when you pass away.
Right.
And the beauty of that is it's tax free.
Right.
So there is a way. It doesn't work in all cases, but if you have a pension and you're looking at the options, you ought to have what we call a Pension Max option looked at you.
And the other thing is that if your spouse predeceases you,
Yep.
you're locked into that smaller amount usually forever. So
Right.
you're still getting that $1,500 even though your spouse may have predeceased you. But if you do the pension max, then you can drop the life insurance and continue with the larger option. So
Or
you can keep the life
insurance and give it to your kids.
if you want to do that as well.
Because when you take that lower amount, like you said, if she passes away, you're stuck with that lower amount for your lifetime. So it offers a lot of flexibility. It's not for everybody, and it doesn't work in all cases. But when it works, it's like a hand in glove.
Yep. Works really, really well.
All right.
So pension maximization strategy. So that's the other option out there as well when you're considering looking at your pension.
All right, Josh, I hear the bumper. Take it away, boy.
You got it. If you want to join the conversation, the number to call is 844-580-9326, 844-580-WDBO. If you want to hop on the WDBO open mic and send in your question that way, get your questions answered by none other than the team, the wonderful team at the Certified Financial Group. If you want to call in, 844-580-9326. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group. Welcome back to On the Money here on WDBO 107.3 FM, AM 580, always streaming inside your WDBO app. You want to join the conversation, now is a great time because we got some certified financial planners with the Certified Financial Group answering your certified financial questions. That's what we do here on Saturday mornings. Joe Bert and Aaron Bert with the Certified Financial Group. Call in now, 844-580-9326. But as the show comes to an end, you may want to hop on the air, the virtual air, the private radio show just for you, because Charles Curry is standing by to take your calls off the air at 407-869-9800. 407-869-9800. Joe Bert, Aaron Bert answering our questions. Another great show. And if you want to pop over to the offices of Certified Financial Group, we got options for that too.
You know, you had mentioned Charles Curry taking the calls. Charles is, in fact, a certified financial planner. All of our planners are certified financial planners, and I think that's the distinction that we have here in town, that all of the people that are going to meet with you are certified financial planner professionals. And that's why we can call ourselves legitimately fiduciaries, and I think that's the distinction. So we got a text question. You want to take it away, Josh?
You got it, 844-580-9326. Question comes to us from Daytona Beach. Most of the options inside my 401k plan are funds with a year associated with them. For example, 2025. They seem to be doing well, and they're at a low cost. But are there any downsides to using these as an investment strategy?
So what that is in reference to is what's called a target date fund, and there's various companies that offer target date funds, and you usually find them within retirement plans, but they're also available to individual investors as well. And what it is it's an investment strategy, and it's usually it's kind of auto set up, right? So it's set up by the investment company with what's called a glide path. And as you approach that retirement date, it starts to get more conservative, so that when you basically reach that date, the bottom doesn't fall out and you find yourself in a very aggressive portfolio. So the idea is the further away you are from that date, the more aggressive you are because you have more time. And the closer you get to that date, it starts to get more and more conservative. And then usually it runs past that target date a little bit, a couple years or so, to get to the most conservative portfolio. And then you'll transfer into what they call a retirement income portfolio. And that's like a kind of a set it and forget it type strategy in retirement plans to be able to put your money in there, get diversification, and not have to manage it or pick individual funds on your own. Because we find that a lot with individual 401k participants, that they're, listening to what their brother-in-law does or what their coworker does and, chasing returns. And that can be a disaster in your retirement plan if you're trying to chase returns. So
Yeah, the target date funds are, as Aaron said, designed to coincide with your retirement date to become more conservative as you get there. But they could be and should be maybe part of a balanced portfolio, perhaps use a model portfolio as well. So I hear the bumper music. Want to take it away there?
You got it. Again, Charles Curry standing by off the air, 407-869-9800, 407-869-9800. Charles Curry standing by to answer your financial questions. You've just listened to On the Money, where we're helping you plan tomorrow
Today
with the Certified Financial Group.